Hello, welcome back. I'm happy to see you again. We are now in week 3 of our MOOC, where we are going to deal with the financing of the company and its ability to face its financial commitments. You remember that in week 1, we looked at the margins with the idea that a company which cannot sell its product or services at a price higher than it costs will not be able to survive. Then, in week 2, we said, but in order to generate positive margins and to maintain them through time, a company needs to invest in fixed capital and in net working capital. Now, we are going to add that to be able to invest, to be able to employ capital, the company needs to find the financing. Week 3 will therefore be devoted to financing. Basically, the company has 3 sources of financing. Debt, provided by the lenders, like banks, for instance. Equity, provided by shareholders, investors. And then, during its activity, the company generates its own financing through the cash flow from its sales. We will first look at financing from a dynamic viewpoint. How has the company financed itself through time over the last years? This will be covered in this video and in the next 2 ones. After that, in video 4, we will study financing from a static point of view and ask ourselves, today, is the company able to repay its debt? Has the company the ability to face its financial obligations vis-à-vis its bankers and its debt holders in general? Let's start with a dynamic point of view. The key here is to understand how the cash has circulated. What have been the sources and uses of funds over a certain period of time? Let's take a very simple example. Let's assume a company which has sales of 100. Purchase of raw materials, let's say of 40. I could put minus, but I put it in bracket. It's an expense. Wages and salaries, let's say 30. And depreciation of the equipment is 10. You see that if I was stopping here, 10 minus 40 minus 30 minus 10 will be 20. That will be the operating profit, the EBIT, as we call it earlier. Let's assume that net interest is 2. And therefore, this leads to 100 minus 40 minus 30 minus 10 minus 2, 18, profit before tax. Tax rate is 33%, 1/3. So 1/3 of 18 is 6. And 18 minus 6 leads to a net profit of 12. Now let's put now that in a framework of cash. And we assume that there is no net working capital. In other words, the customers are paying cash, we are paying our raw materials cash. What's going on here? 100 are coming. All the customers are paying cash. We are paying all our suppliers cash, 40. Wage and salaries, no problem. We pay them, 30. And then here we have depreciation. Remember what we said? Depreciation is a non-cash expense. It's not leaving the company. So no cash impact. Net interest, we have to pay them to the bank or to the debt holders. Taxes. And therefore, if you do that, 100 minus 40 minus 30 minus 2 minus 6, you'll find 22. 22 is a cash impact. It's a cash flow, in fact, assuming that you have no net working capital. And you see that how do we get that? This 22 is, in fact, the 12 net profit plus the depreciation. 12 plus 10 equal to 22. That's what people have called for a long time cash flow. Some companies still call it cash flow earnings, but it's not real cash. It's because there is no net working capital. We are going to call it IGF, internally generated funds. Now, let's take a view if we assume now that we have net working capital. In other words, we sold 100, but not all our customers are going to pay, and only 92 are going to be collected. So we have 8 of credit to our customers. We bought some raw materials, but we don't pay for all of them. We just paid for 35. Now, wages, salaries, there is no choice. We have to pay them, so it will be 30. Depreciation is still a non-cash expense, not getting out of the company. Then we have the 2 of interest that you have to pay to the bank, and the 6 that you have to pay to the tax man. And if you do that, 92 minus 35 minus 30 minus 2 minus 6, you'd find 19. 19 is the cash flow, assuming that you have net working capital. Why is it different from the 22? Because we receive only 92 instead of 100. We have accounts receivables of 8. And we paid only 35 instead of 40. So we have accounts payable of 5. And remember the definition? 8 minus 5 is 3. So the difference here is the difference between the 22 and 19, which is 3. And we are going to call the cash flow from operations the IGF plus or minus, here it's a minus, the change in net working capital. As you see on the slide, the definition of cash flow from operation is net profit plus depreciation and amortization plus or minus change in net working capital, depending if it's going up or down. Cash flow from operation is essential as it measures the ability of my day-to-day operation to generate cash. As I said sometimes, CFO should be the obsession of the CFO. The cash flow from operation should be the obsession of the chief financial officer. If operations are not generating enough cash, how will the company be able to finance its investments, those required for its growth and its competitiveness? How will the company be able to repay its financial debt, short-term or long-term? How will the company be able to pay dividends to its shareholders? This is exactly the type of question that the cash flow statement will help us answering. Let's just take a brief look to finish this first video of week 3 at a standard cash flow statement. As you see on the slide, net profit, first line, which is the last line of our P&L, plus depreciation amortization, plus or minus the change in net working capital, and we get the cash flow from operations. Then we deduct the CapEx, the capital expenditure, the investment, and we add, if any, the asset disposal, and we get the cash flow before financing. And then you have all the financing operations, dividend payments, repayment of debts, new debt, issue of capital, etc., to get the total cash flow. So you see 3 stages: current operations, investment operations, financing operations. In the next video, we will look with more details at the bottom part of the cash flow statement. What is below the cash flow from operations? And we will apply that to our company, Gremlin. So see you in a few minutes.